Question 1. Strategic planning requires a thorough understanding of regulatory obligations. A junior analyst in BNP Paribas' London office has been asked by a senior manager to approve marketing materials for a new investment product. The analyst, reviewing the materials, identifies several statements that appear to overstate potential returns and understate associated risks, potentially contravening FCA rules on financial promotion. The senior manager insists the materials are acceptable and urges the analyst to sign off quickly to meet a launch deadline. What is the most appropriate course of action for the junior analyst? Option A. Ignore the request and focus on other tasks, assuming the senior manager will find someone else to approve the materials. Option B. Immediately escalate the concerns to the compliance department for their review and guidance before approving the materials. Option C. Directly challenge the senior manager's interpretation of the regulatory requirements and attempt to persuade them to amend the materials. Option D. Approve the marketing materials as requested by the senior manager, assuming their experience overrides any potential regulatory concerns. The correct answer is B. Immediately escalate the concerns to the compliance department for their review and guidance before approving the materials. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the immediate need for business development with the long-term imperative of regulatory compliance. The pressure to secure new business can lead to overlooking or downplaying potential compliance risks. A junior analyst must exercise sound judgment to identify and escalate these risks appropriately, even when faced with senior management's enthusiasm for a deal. Correct approach analysis. The correct approach represents best professional practice because it prioritizes adherence to the firm's internal compliance policies and relevant regulatory frameworks, specifically the UK Financial Conduct Authority (FCA) Handbook. The FCA's Principles for Businesses, particularly Principle 3, Management and Control, and Principle 7, Communications with Clients, mandate that firms must have adequate systems and controls in place to manage risks and ensure that communications are fair, clear, and not misleading. By seeking guidance from the compliance department, the analyst is ensuring that the proposed marketing materials are reviewed against these principles and any specific rules related to financial promotions, e.g., COBS 4. This proactive step mitigates the risk of regulatory breaches, reputational damage, and potential client harm. Incorrect approaches analysis. An approach that involves proceeding with the marketing materials without further review, assuming the senior manager's approval is sufficient, fails to acknowledge the independent oversight role of the compliance department and the potential for senior management to overlook regulatory nuances. This could lead to breaches of FCA rules regarding financial promotions, potentially resulting in fines, disciplinary action, and damage to the firm's reputation. It also violates the firm's internal control framework, which typically mandates compliance review for client-facing materials. An approach that involves directly questioning the senior manager's understanding of regulatory requirements without involving compliance could escalate internal conflict and may not resolve the underlying compliance issue. While understanding the business perspective is important, the ultimate responsibility for regulatory interpretation and approval rests with the compliance function. This approach risks alienating management and delaying a proper compliance assessment. An approach that involves ignoring the senior manager's request and proceeding with other tasks without any communication about the marketing materials would be a failure to engage with a business request and could be perceived as insubordination. While it avoids immediate compliance risk, it does not address the business need and fails to demonstrate proactive risk management by seeking appropriate channels for resolution. Professional reasoning. Professionals should adopt a structured decision-making process when encountering potential compliance issues. This involves 1. Identifying the potential risk. Recognize when a situation might involve a breach of regulations or internal policies. 2. Consulting internal policies and procedures. Refer to the firm's compliance manual and relevant regulatory guidance. 3. Escalating to the appropriate function. Involve the compliance department for expert advice and review. 4. Documenting the process. Keep records of communications and decisions made. 5. Seeking clarification and resolution. Work collaboratively with relevant departments to find compliance solutions. Question 2. Implementation of a robust anti-money laundering (AML) framework requires compliance officers to act decisively when suspicious transactions are identified. A junior compliance officer at a UK-based investment bank has flagged a series of complex international transfers initiated by a long-standing client, which appear unusual given the client's typical business profile and risk appetite. What is the most appropriate immediate course of action for the junior compliance officer to take, adhering strictly to UK regulatory expectations? Option A. Advise the client that their transactions have been flagged as suspicious and seek clarification directly from them. Option B. Conduct a thorough internal review of the client's transaction history, business activities, and the specific nature of the flagged transfers, documenting all findings and assessments. Before considering escalation, Option C. Ignore the flagged transactions as they are from a long-standing client and may represent a temporary anomaly. Option D. Immediately file a suspicious activity report (SAR) with the National Crime Agency (NCA) based on the initial suspicion. The correct answer is B. Conduct a thorough internal review of the client's transaction history, business activities, and the specific nature of the flagged transfers, documenting all findings and assessments before considering escalation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between client confidentiality and the regulatory obligation to report suspicious activities. A junior compliance officer must navigate this delicate balance, understanding that a failure to report could lead to significant regulatory penalties and reputational damage for the firm, while an overzealous or incorrect reporting could breach client trust and potentially harm legitimate business relationships. The need for accurate assessment and timely action is paramount. Correct approach analysis. The correct approach involves a thorough, documented internal investigation before escalating to the relevant authorities. This aligns with the principles of regulatory compliance, particularly under frameworks like the UK's Proceeds of Crime Act 2002, POCA, and the Financial Conduct Authority's FCA rules. The firm has a legal and ethical duty to establish if a suspicious activity report (SAR) is genuinely warranted. This internal review allows for the gathering of all relevant facts, assessing the intent behind the transaction, and determining if it crosses the threshold for suspicion of money laundering or terrorist financing. This process ensures that SARs are not filed frivolously, which can overburden the National Crime Agency (NCA) and potentially lead to unnecessary scrutiny of innocent clients. Documenting this process is crucial for demonstrating due diligence to regulators. Incorrect approaches analysis. One incorrect approach involves immediately filing a SAR without any internal investigation. This fails to meet the professional standard of due diligence. While the intention might be to err on the side of caution, it bypasses the firm's responsibility to conduct its own assessment and could lead to the filing of unwarranted SARs, potentially breaching client confidentiality unnecessarily and misdirecting law enforcement resources. This could be seen as a failure to adequately assess the situation before reporting, which is a core compliance expectation. Another incorrect approach is to ignore the transaction and take no action. This is a direct breach of regulatory obligations. Firms have a statutory duty to report suspicious activity. Failure to do so, especially when there are indicators of potential financial crime, can result in severe penalties, including substantial fines and criminal charges for the firm and individuals involved. This demonstrates a willful disregard for anti-money laundering (AML) regulations. A third incorrect approach is to discuss the suspicion directly with the client before reporting. This is known as tipping off and is a serious criminal offense under POCA. It compromises the integrity of any potential investigation by law enforcement and allows criminals to conceal their activities. This action fundamentally undermines the purpose of the SAR regime. Professional reasoning. Professionals in compliance must adopt a structured decision-making process. This begins with identifying potential red flags. Next, gather all available information related to the flagged activity. Then, conduct a risk-based internal assessment to determine if the activity meets the threshold for suspicion of financial crime, documenting all steps and findings. If suspicion remains after the internal assessment, then proceed with filing a SAR through the appropriate channels, ensuring no tipping off occurs. If the suspicion is unfounded, document the reasons for not reporting. This systematic approach ensures both regulatory adherence and professional integrity. Question 3. Governance review demonstrates a pattern of inconsistent application of internal policies related to client onboarding, leading to potential breaches of anti-money laundering AML regulations. The review highlights that, while some staff are diligent, others are not consistently verifying all required documentation or conducting adequate due diligence checks. What is the most appropriate immediate response for the head of compliance? Option A. Delegate the responsibility of addressing the AML policy inconsistencies to the individual team managers without providing specific guidance or oversight. Option B. Immediately suspend all new client onboarding until a full audit of all past onboarding processes can be completed, which could take several months. Option C. Issue a stern warning to all staff involved, emphasizing the seriousness of AML regulations and the potential consequences of non-compliance, and rely on existing supervision to ensure adherence. Option D. Initiate a comprehensive review of the AML policies and procedures, conduct targeted training for all staff involved in client onboarding, and implement enhanced monitoring of onboarding processes to identify and rectify any further deviations. The correct answer is D. Initiate a comprehensive review of the AML policies and procedures, conduct targeted training for all staff involved in client onboarding, and implement enhanced monitoring of onboarding processes to identify and rectify any further deviations. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for efficient internal processes with the absolute imperative of regulatory compliance. The pressure to meet business objectives can sometimes lead to shortcuts or a less rigorous interpretation of rules, which can have severe consequences. The challenge lies in identifying potential breaches before they become systemic issues and ensuring that the firm's culture actively promotes adherence to regulations. Correct approach analysis. The correct approach involves a proactive and thorough investigation of the identified governance weaknesses. This demonstrates best professional practice by acknowledging the findings, initiating a root cause analysis, and developing a remediation plan that addresses the underlying issues, not just the symptoms. This aligns with the principles of sound governance and regulatory oversight, ensuring that the firm operates within the established legal and ethical boundaries. Specifically, it reflects a commitment to the principles of the UK Financial Conduct Authority (FCA) Handbook, particularly SISC, Senior Management Arrangements, Systems and Controls, which mandates firms to have adequate systems and controls in place to manage risks and comply with regulatory requirements. Incorrect approaches analysis. One incorrect approach would be to dismiss the findings as minor operational inefficiencies without further investigation. This fails to acknowledge the potential for these inefficiencies to escalate into significant compliance breaches, violating the FCA's expectation that firms take all reasonable steps to comply with regulations. It also neglects the principle of treating customers fairly if these inefficiencies negatively impact clients. Another incorrect approach would be to implement superficial changes that do not address the root cause of the governance weaknesses. This is a failure to establish and maintain effective systems and controls, as required by SISC. It creates a false sense of compliance while leaving the firm vulnerable to future regulatory scrutiny and potential enforcement action. A third incorrect approach would be to focus solely on disciplinary action against individuals without understanding the systemic issues that may have contributed to the governance weaknesses. While accountability is important, a purely punitive approach without addressing process or cultural failures is unlikely to prevent recurrence and may foster a climate of fear rather than a culture of compliance. This would also fail to meet the FCA's expectations for firms to foster a culture that supports compliance. Professional reasoning. Professionals should approach such situations by adopting a structured problem-solving framework. This involves 1. Acknowledging and validating the findings of the review. 2. Conducting a thorough root cause analysis to understand the why behind the governance weaknesses. 3. Developing a comprehensive and actionable remediation plan with clear ownership and timelines. 4. Implementing the plan rigorously and monitoring its effectiveness. 5. Embedding lessons learned into the firm's culture and processes to prevent future occurrences. This systematic approach ensures that regulatory obligations are met and that the firm's integrity is maintained. Question 4. The control framework reveals that a new, sophisticated cyber threat has emerged, capable of exploiting vulnerabilities not previously observed. While historical incident data shows no direct impact from this specific threat vector, industry intelligence suggests it is rapidly evolving and poses a significant potential risk to financial institutions. Which approach to risk assessment best aligns with regulatory expectations and professional best practice for BNP Paribas? Option A. Focus solely on the firm's internal IT infrastructure vulnerabilities, disregarding external intelligence on emerging threats until they manifest internally. Option B. Conduct a thorough assessment of the new threat's potential impact and likelihood, incorporating industry intelligence and forward-looking analysis to update existing controls and develop new mitigation strategies. Option C. Prioritize immediate resource allocation to address the most frequently occurring historical cyber threats, as these represent the most statistically probable risks. Option D. Defer action until the threat has demonstrably impacted the firm or similar institutions, relying on historical incident data to inform any subsequent response. The correct answer is B. Conduct a thorough assessment of the new threat's potential impact and likelihood, incorporating industry intelligence and forward-looking analysis to update existing controls and develop new mitigation strategies. Explanation: this scenario presents a professional challenge because it requires an assessment of risk in a dynamic environment where new information can significantly alter the perceived threat landscape. Challenge lies in balancing the need for proactive risk mitigation with the potential for overreaction or underestimation of emerging risks. Careful judgment is required to ensure that risk assessments are both comprehensive and proportionate, aligning with the firm's risk appetite and regulatory obligations. The correct approach represents best professional practice because it involves a systematic and iterative process of identifying, assessing, and responding to risks. This aligns with the principles of sound risk management expected by regulators, such as those outlined in the UK Financial Conduct Authority (FCA) Handbook, e.g., CISC 3 and CISC 6, which mandate firms to have adequate systems and controls to manage risks. Specifically, a forward-looking approach that considers potential future impacts and incorporates diverse data sources demonstrates a commitment to proactive risk management, key tenet of regulatory compliance and ethical conduct. This approach ensures that the firm is not only reacting to current threats, but also anticipating and preparing for future ones, thereby safeguarding its operations and clients. An incorrect approach that focuses solely on historical data without considering emerging trends would be professionally unacceptable. This failure would contravene regulatory expectations for a dynamic risk assessment process. For instance, the FCA expects firms to adapt their controls to evolving market conditions and new types of threats. Relying only on past incidents might lead to a false sense of security and leave the firm vulnerable to novel risks, representing a breach of the duty of care and potentially violating principles of treating customers fairly. Another incorrect approach, such as prioritizing the most visible or vocal concerns over those with a potentially higher, albeit less apparent, impact, would also be a regulatory and ethical failure. This demonstrates a lack of objective risk assessment and could lead to misallocation of resources, leaving critical but less publicized risks unaddressed. This could be seen as a failure to implement robust risk management systems as required by regulatory frameworks, potentially leading to systemic weaknesses. Professionals should employ a decision-making framework that begins with clearly defining the scope and objectives of the risk assessment. This involves identifying all relevant stakeholders and potential risk categories. The next step is to gather comprehensive data, including historical information, current market intelligence, and forward-looking indicators. This data should then be analyzed using appropriate methodologies to assess the likelihood and impact of identified risks. Crucially, the assessment should consider the firm's risk appetite and tolerance levels. Finally, based on the assessment, appropriate mitigation strategies should be developed, implemented, and continuously monitored and reviewed. This iterative process ensures that risk management remains a live and effective function within the organization. Question 5. Compliance review shows that the risk assessment process for a new derivative product is heavily reliant on data provided by the product development team, and the assessment team has historically worked closely with this team on other projects. What is the most appropriate next step to ensure the integrity of the risk assessment? Option A. Expedite the risk assessment process by using a pre-existing, generic risk assessment template to ensure timely product launch. Option B. Allow the product development team to select the members of the risk assessment team to ensure their familiarity with the product. Option C. Conduct a thorough review of the risk assessment methodology, data sources, and the independence of the risk assessment team, potentially involving an independent third party for validation. Option D. Proceed with the risk assessment as planned, assuming the product development team's data is accurate and the existing working relationship will not introduce bias. The correct answer is C. Conduct a thorough review of the risk assessment methodology, data sources, and the independence of the risk assessment team, potentially involving an independent third party for validation. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the need for efficient risk assessment with the imperative to adhere to regulatory requirements and ethical standards. The challenge lies in identifying potential conflicts of interest and ensuring that the risk assessment process remains objective and unbiased, even when faced with internal pressures or established relationships. A superficial or rushed approach could lead to overlooking critical risks, while an overly cautious approach might hinder business operations. The professional must exercise sound judgment to navigate these competing demands. Correct approach analysis. The correct approach involves a comprehensive and documented review of the existing risk assessment framework, specifically scrutinizing the independence of the risk assessment team and the data sources used. This aligns with regulatory expectations for robust risk management, emphasizing objectivity and the avoidance of conflicts of interest. By ensuring that the risk assessment is conducted by individuals or teams free from undue influence, and that data is reliable and unmanipulated, the firm upholds its commitment to accurate risk identification and mitigation, thereby protecting its stakeholders and maintaining market integrity. This proactive review demonstrates a commitment to best practices in risk governance. Incorrect approaches analysis. One incorrect approach involves relying solely on the historical performance data without re-evaluating the methodology or the independence of the assessors. This fails to address the potential for outdated assumptions or ingrained biases that may no longer reflect current market conditions or internal dynamics. It also risks overlooking emerging risks that historical data might not capture. Ethically, this approach could be seen as negligent if it leads to inadequate risk mitigation. Another incorrect approach is to prioritize speed and efficiency by using a standardized, one-size-fits-all risk assessment template, without considering the unique characteristics of the business unit or product being assessed. This can lead to a superficial understanding of specific risks, potentially missing critical vulnerabilities. Regulatory frameworks often mandate a risk-based approach that is tailored to the specific activities and risk profile of the firm, making a generic approach insufficient and potentially non-compliant. A third incorrect approach involves allowing the business unit being assessed to have significant input into the selection of the risk assessment team or the definition of risk appetite. This creates a clear conflict of interest, undermining the objectivity and credibility of the entire risk assessment process. Regulators expect independent oversight and challenge, and this approach directly contravenes that principle, posing a significant ethical and regulatory failure. Professional reasoning. Professionals should adopt a structured decision-making process that begins with understanding the regulatory mandate for risk assessment, including requirements for independence, objectivity, and thoroughness. They should then critically evaluate the current assessment process against these mandates, identifying any potential gaps or weaknesses. When faced with scenarios like this, the professional should prioritize a review that ensures the integrity of the risk assessment, even if it requires additional time or resources. This involves seeking independent validation, ensuring data integrity, and rigorously testing for conflicts of interest. The ultimate goal is to foster a culture of robust risk management that is both compliant and effective. Question 6. Investigation of a new artificial intelligence-driven trading algorithm's potential impact on market stability requires a comprehensive risk assessment. Which of the following methodologies best aligns with regulatory expectations for identifying and evaluating such emerging risks? Option A. Prioritizing risks based on the volume of media coverage they have received, assuming higher coverage indicates greater potential impact. Option B. Conducting a thorough analysis of the algorithm's code and backtesting its performance against historical market data, supplemented by expert consultations to identify potential failure modes and their likely impact. Option C. Focusing exclusively on risks that have materialized in previous trading algorithm deployments, regardless of the new algorithm's unique characteristics. Option D. Relying on informal discussions with senior traders and IT staff to gauge their general sentiment regarding the algorithm's potential risks. The correct answer is B. Conducting a thorough analysis of the algorithm's code and backtesting its performance against historical market data, supplemented by expert consultations to identify potential failure modes and their likely impact. Explanation. This scenario presents a professional challenge due to the inherent subjectivity in assessing the likelihood and impact of emerging risks, particularly those stemming from novel technological advancements. The firm must balance proactive risk mitigation with the need for operational efficiency and avoid stifling innovation. Careful judgment is required to distinguish between speculative fears and credible threats that warrant resource allocation. The correct approach represents best professional practice because it employs a structured, evidence-based methodology for risk assessment. It involves identifying potential risks, analyzing their likelihood and impact, and then prioritizing them based on a defined framework. This aligns with regulatory expectations for robust risk management, such as those outlined by the Financial Conduct Authority, FCA, in the UK, which emphasizes a proactive and proportionate approach to identifying and managing all material risks. Specifically, the FCA's Principles for Businesses and Senior Management Arrangements, Systems and Controls handbook require firms to have adequate systems and controls in place to manage risks effectively. A systematic approach ensures that decisions are defensible, auditable, and contribute to the firm's overall resilience and compliance. An incorrect approach that relies solely on anecdotal evidence or the loudest voices within the organization fails to meet regulatory standards. This could lead to misallocation of resources, either by overinvesting in improbable risks or underinvesting in significant ones. Ethically, it demonstrates a lack of due diligence and a failure to uphold the firm's responsibility to its stakeholders, including clients and the broader financial system. Another incorrect approach, focusing only on historical data, is insufficient in a rapidly evolving technological landscape. Emerging risks, by definition, may not have a historical precedent, and relying solely on past events would leave the firm vulnerable to unforeseen threats, violating the principle of forward-looking risk management expected by regulators. Ignoring potential risks due to their perceived complexity or novelty is a direct contravention of the duty to identify and manage all material risks, potentially leading to significant financial and reputational damage and regulatory sanctions. The professional decision-making process for similar situations should involve a multidisciplinary team to gather diverse perspectives. This team should establish clear criteria for risk identification and assessment, utilizing both qualitative and quantitative methods where appropriate. Regular review and updating of the risk register are crucial, especially in dynamic environments. The process should foster a culture where employees feel empowered to raise potential risks without fear of reprisal, ensuring that all relevant information is considered. This systematic and inclusive approach ensures that risk assessments are comprehensive, objective, and actionable, thereby supporting sound business decisions and regulatory compliance. Question 7. What factors determine the effectiveness of a firm's approach to assessing and managing operational risks within a complex financial services environment, considering both current and potential future threats? Option A. The prioritization of risks based solely on their perceived likelihood of occurrence, irrespective of their potential financial or reputational impact on the firm. Option B. The integration of forward-looking scenario analysis with historical loss data, an understanding of the firm's strategic objectives, and the evaluation of control effectiveness across interconnected risk categories. Option C. A sole reliance on historical incident reports and the frequency of past operational failures, without considering evolving market dynamics or new technological vulnerabilities. Option D. The isolation of each identified risk into a separate assessment, without considering how different risk events might interact or amplify each other. The correct answer is B. The integration of forward-looking scenario analysis with historical loss data, an understanding of the firm's strategic objectives, and the evaluation of control effectiveness across interconnected risk categories. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of risk assessment beyond simple identification. The challenge lies in prioritizing and integrating various risk factors in a dynamic financial environment, ensuring that the assessment is not only comprehensive, but also actionable and compliant with regulatory expectations. The firm must balance the need for robust risk management with operational efficiency and strategic objectives. The correct approach represents best professional practice because it emphasizes a holistic and forward-looking perspective on risk. It acknowledges that risk is not static and requires continuous monitoring and adaptation. By considering the interconnectedness of different risk types, the potential impact on the firm's strategic goals, and the effectiveness of existing controls, this approach ensures that resources are allocated effectively to mitigate the most significant threats. This aligns with regulatory expectations for a proactive and integrated risk management framework, promoting financial stability and client protection. An incorrect approach that focuses solely on historical data without considering emerging trends or future uncertainties fails to meet regulatory requirements for forward-looking risk assessment. It can lead to a false sense of security and leave the firm vulnerable to unforeseen events. Another incorrect approach that prioritizes only the likelihood of a risk event, neglecting its potential impact, is also deficient. Regulators expect a balanced consideration of both probability and severity to understand the true magnitude of potential losses. Furthermore, an approach that overlooks the interdependencies between different risk categories can result in a fragmented and ineffective risk mitigation strategy, as risks often manifest in combination, amplifying their overall effect. Professionals should employ a decision-making framework that begins with clearly defining the scope and objectives of the risk assessment. This involves identifying all relevant risk categories, considering both internal and external factors, and understanding the firm's risk appetite. The next step is to gather and analyze data, using a combination of quantitative and qualitative methods. Crucially, the assessment must involve scenario planning and stress testing to understand potential impacts under adverse conditions. Finally, the findings should be translated into actionable mitigation strategies, with clear ownership, timelines, and monitoring mechanisms, ensuring continuous review and adaptation to evolving risk landscapes. Question 8. When evaluating the potential impact of a new market entry strategy on a financial institution's operational resilience, which of the following risk assessment methodologies would be most appropriate for a junior analyst to propose for initial consideration? Option A. A qualitative assessment that prioritizes risks based on a combination of their potential severity and the likelihood of their occurrence, using a defined matrix. Option B. An assessment that relies on the subjective opinions of the most experienced team members without formal data collection or analysis. Option C. A quantitative assessment that requires detailed historical data and complex statistical modeling to assign precise financial values to all potential operational disruptions. Option D. An assessment that focuses exclusively on the worst-case scenario impact, regardless of the probability of such an event materializing. Correct answer is A. A qualitative assessment that prioritizes risks based on a combination of their potential severity and the likelihood of their occurrence, using a defined matrix. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of risk assessment beyond simple identification. The challenge lies in distinguishing between a potential risk and a risk that warrants immediate, significant mitigation based on its likelihood and impact, particularly within the context of financial services regulations. A junior analyst might be tempted to flag every potential issue, leading to inefficient resource allocation and a diluted focus on truly material risks. The correct approach represents best professional practice because it aligns with the principles of effective risk management, mandated by regulatory frameworks such as those governing financial institutions. It emphasizes a structured, data-driven assessment of both the probability of a risk event occurring and the potential severity of its consequences. This allows for prioritization, ensuring that resources are directed towards the most critical threats. This aligns with regulatory expectations for robust internal controls and risk mitigation strategies, aiming to protect the firm and its clients from financial loss and reputational damage. An incorrect approach that focuses solely on the potential impact without considering likelihood would be professionally unacceptable. This is because it could lead to overallocation of resources to low-probability, high-impact events, diverting attention from more probable and damaging risks. It fails to meet the regulatory requirement for a balanced and proportionate risk assessment. Another incorrect approach which relies on anecdotal evidence or personal intuition rather than systematic analysis, is also professionally unacceptable. This is due to its inherent subjectivity and lack of empirical grounding, making it difficult to defend to regulators or senior management. Such an approach risks overlooking critical risks or misjudging their severity, potentially leading to breaches of regulatory compliance and increased vulnerability. The professional decision-making process for similar situations should involve a clear framework. First, identify all potential risks. Second, gather relevant data and information to assess the likelihood and impact of each identified risk. Third, categorize and prioritize risks based on this assessment. Fourth, develop and implement appropriate mitigation strategies for high-priority risks. Finally, continuously monitor and review the risk landscape and the effectiveness of mitigation measures. This systematic approach ensures that risk management is proactive, efficient, and compliant with regulatory expectations. Question 9. Operational review demonstrates that the firm has a well-documented incident response plan and a comprehensive risk register that is updated quarterly. However, there is no formal process for horizon scanning or scenario planning to identify potential future risks that are not currently captured. Which of the following represents the most significant control weakness in the firm's risk assessment approach? Option A. The absence of a proactive risk identification process that anticipates emerging threats. Option B. The comprehensiveness of the current risk register. Option C. The cost-effectiveness of current risk mitigation measures. Option D. The efficiency of the incident response team. The correct answer is A. The absence of a proactive risk identification process that anticipates emerging threats. Explanation. Scenario analysis. This scenario presents a challenge in risk assessment by requiring the identification of a control weakness that is not immediately obvious and could lead to significant reputational and financial damage. The difficulty lies in discerning the subtle but critical gap in the existing risk mitigation strategy, which relies on a reactive rather than proactive approach. Professional judgment is required to move beyond surface-level controls and identify the underlying vulnerability. Correct approach analysis. The correct approach focuses on the absence of a forward-looking risk identification process. Best professional practice dictates that a robust risk assessment framework should not only identify existing risks and controls, but also proactively anticipate emerging threats and vulnerabilities. This involves scenario planning, horizon scanning, and stress testing to understand potential future impacts. In the context of regulatory compliance and operational resilience, a failure to proactively identify risks leaves the firm exposed to unforeseen events, which can lead to breaches of regulatory expectations, e.g., under frameworks like the PRA Rulebook or FCA Handbook in the UK, or similar principles in other jurisdictions if specified for the exam. Ethically, it represents a failure to exercise due diligence in protecting the firm and its stakeholders. Incorrect approach is analysis. One incorrect approach might focus on the efficiency of the current incident response team. While an efficient response is important, it addresses the symptom rather than the cause. The regulatory and ethical failure here is a misdiagnosis of the core problem. The firm is still vulnerable to the risk occurring in the first place, and the focus on response efficiency can create a false sense of security, masking the underlying control gap. This could be seen as a failure to adhere to principles of effective risk management and internal control, potentially contravening expectations for robust operational resilience. Another incorrect approach might highlight the cost-effectiveness of the current risk mitigation measures. While cost is a consideration, it should not supersede the effectiveness of risk management. The regulatory and ethical failure is prioritizing cost over adequate risk coverage. This can lead to undersourcing of critical risk functions and controls, leaving the firm exposed to risks that could have been mitigated at a reasonable cost. This would be a direct contravention of the duty to manage risks prudently and effectively, potentially violating principles of sound governance and risk appetite. A third incorrect approach could suggest that the current risk register is comprehensive. A comprehensive risk register is a good starting point, but its value diminishes if it is not actively used to drive proactive risk mitigation and strategic planning. The regulatory and ethical failure is in treating the risk register as a static document rather than a dynamic tool for ongoing risk management. This can lead to a failure to adapt to changing risk landscapes and emerging threats, which is a fundamental flaw in risk assessment and control. It implies a lack of proactive risk management, a key expectation from regulators focused on preventing systemic issues. Professional reasoning. Professionals should employ a structured risk assessment process that moves beyond simply documenting existing risks. This involves 1. Understanding the business objectives and strategic priorities. 2. Identifying potential threats and vulnerabilities, both internal and external, current and future. 3. Evaluating the likelihood and impact of identified risks. 4. Designing and implementing appropriate controls, prioritizing proactive measures. 5. Continuously monitoring and reviewing the risk landscape and the effectiveness of controls. 6. Ensuring that risk appetite is clearly defined and adhered to. This systematic approach ensures that risk management is integrated into the firm's strategy and operations, rather than being a standalone compliance exercise. Question 10. The assessment process reveals that a junior analyst has identified a potential operational risk associated with a newly implemented trading system, citing an unusual pattern in transaction processing times. The analyst has flagged this as a concern, but has not yet conducted a detailed analysis of the pattern's frequency, potential impact, or root cause. What is the most appropriate immediate next step for the analyst and their supervisor? Option A. Immediately escalate the concern to senior management, highlighting the potential for system failure and significant financial loss, requesting urgent intervention. Option B. Propose and implement an immediate broad system shutdown or significant operational change to prevent any potential disruption, pending a full investigation. Option C. Advise the junior analyst that such minor anomalies are common with new systems and likely to resolve themselves, and therefore no further action is required at this stage. Option D. Conduct a preliminary risk assessment to understand the nature, likelihood, and potential impact of the identified pattern, documenting findings and potential mitigation strategies before escalating to senior management. The correct answer is D. Conduct a preliminary risk assessment to understand the nature, likelihood, and potential impact of the identified pattern, documenting findings and potential mitigation strategies before escalating to senior management. Explanation. The assessment process reveals a scenario where a junior analyst has identified a potential operational risk stemming from a new trading system. The challenge lies in the analyst's limited experience and the potential for overreaction or underestimation of the risk. The firm's reputation and financial stability are at stake, necessitating a robust and compliant risk assessment. The correct approach involves a structured, multi-stage risk assessment process that aligns with regulatory expectations for operational risk management. This includes initial identification, qualitative and quantitative analysis, mitigation strategy development, and ongoing monitoring. This approach ensures that risks are understood, quantified where possible, and managed effectively, thereby adhering to principles of sound risk management and regulatory compliance, such as those outlined by the Financial Conduct Authority, FCA, in the UK, which emphasizes a proactive and proportionate approach to risk. An incorrect approach of immediately escalating the issue to senior management without proper initial analysis is professionally challenging because it bypasses the established risk management framework. This can lead to inefficient use of senior resources, potential panic, and a failure to demonstrate due diligence in risk assessment. From a regulatory perspective, it suggests a lack of internal control and a failure to follow established procedures, which could be viewed as a breach of the FCA's principles for businesses, particularly Principle 3, Management and Control. Another incorrect approach of dismissing the risk due to the analyst's junior status is professionally unacceptable, as it ignores a potentially significant threat based on seniority rather than the merits of the risk itself. This demonstrates poor risk culture and a failure to empower employees to report concerns. Ethically, it is a dereliction of duty to protect the firm and its clients from harm. Regulatory bodies like the FCA expect firms to have mechanisms for all employees to raise concerns without fear of reprisal and to take all identified risks seriously. A further incorrect approach of implementing an immediate, drastic, and unquantified control measure without a thorough assessment is professionally unsound. While it may appear decisive, it can lead to unnecessary operational disruption, increased costs, and may not even address the root cause of the risk effectively. This demonstrates a lack of analytical rigor and could be seen as a failure to manage operational risk in a proportionate and effective manner. Again, contravening FCA expectations for robust risk management. Professionals should adopt a decision-making framework that prioritizes a systematic and evidence-based approach to risk assessment. This involves understanding the firm's risk appetite, adhering to internal policies and procedures, consulting relevant regulatory guidance, and employing a combination of qualitative and quantitative techniques to evaluate risks. When faced with a new or uncertain risk, the process should involve 1. Thorough identification and documentation, 2. Assessment of likelihood and impact, 3. Evaluation of existing controls, 4. Development of appropriate mitigation strategies, and 5. Continuous monitoring and review. This structured approach ensures that decisions are informed, justifiable, and compliant with regulatory requirements. Question 11. The efficiency study reveals that certain manual reconciliation processes for trade settlements are time-consuming and resource-intensive. A proposal suggests automating these processes by implementing a new software solution, which is expected to significantly reduce operational costs and processing times. However, the proposal does not include a detailed assessment of how the automation will impact the existing internal controls designed to detect and prevent settlement errors, nor does it specify how the new system will be validated against regulatory reporting requirements. Which of the following represents the most professionally sound approach to evaluating and proceeding with this proposal? Option A. Prioritize the cost savings identified in the study and approve the automation, assuming that the existing control framework will adapt to the new system. Option B. Conduct a thorough risk assessment to understand the potential impact on internal controls and regulatory compliance before approving or rejecting the automation proposal. Option C. Proceed with the automation immediately to realize the cost savings, with a plan to address any control or compliance issues that may arise post-implementation. Option D. Implement the automation on a pilot basis in a limited scope, and only if successful, consider a full rollout without further detailed risk assessment. The correct answer is C. Proceed with the automation immediately to realize the cost savings, with a plan to address any control or compliance issues that may arise post-implementation. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the imperative of maintaining robust risk management and compliance frameworks. The pressure to reduce costs and streamline processes can inadvertently lead to the erosion of critical control mechanisms, potentially exposing the firm to regulatory breaches, financial losses, and reputational damage. Careful judgment is required to ensure that efficiency gains do not compromise the integrity of the firm's operations or its adherence to regulatory expectations. The correct approach represents best professional practice because it prioritizes a comprehensive, risk-based evaluation before implementing any changes. This aligns with the fundamental principles of sound financial management and regulatory compliance, which demand that all operational adjustments are thoroughly assessed for their potential impact on risk profiles and adherence to established laws and guidelines. Specifically, within the UK regulatory framework, such an approach would be guided by the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 3, Management and Control, and Principle 8, Risk Management, which mandate that firms conduct their business with due skill, care, and diligence, and have adequate systems and controls in place to manage risks effectively. This proactive, risk-aware methodology ensures that efficiency is pursued responsibly, without undermining the firm's ability to meet its regulatory obligations and protect its clients. An incorrect approach that focuses solely on cost reduction, without considering the impact on control functions, would represent a significant regulatory and ethical failure. This could lead to breaches of the FCA's principles, particularly those related to adequate systems and controls, and potentially the senior managers and certification regime, SM and CR, which holds senior individuals accountable for the conduct of their firms. Such an approach would also fail to uphold the ethical duty of care owed to clients and the market. Another incorrect approach that prioritizes speed of implementation over thoroughness would similarly risk overlooking critical control gaps, leading to potential operational failures and regulatory scrutiny. This demonstrates a lack of due diligence and a disregard for the firm's responsibility to maintain a sound risk management framework. The professional decision-making process for similar situations should involve a structured, multi-stage evaluation. Firstly, clearly define the objectives of the efficiency initiative. Secondly, conduct a comprehensive risk assessment to identify potential negative impacts on controls, compliance, and client outcomes. Thirdly, consult with relevant stakeholders, including compliance, risk management, and legal departments, to gather diverse perspectives and ensure all potential issues are addressed. Fourthly, develop and implement mitigation strategies for identified risks. Finally, establish ongoing monitoring and review mechanisms to ensure the implemented changes remain effective and compliant over time. This systematic approach ensures that efficiency is achieved in a manner that is both sustainable and compliant with all applicable regulations and ethical standards. Question 12. Risk assessment procedures indicate a recurring anomaly in the firm's client onboarding data, specifically concerning the validation of identity documents. While the current process flags potential discrepancies, the remediation steps taken are often ad hoc and lack comprehensive documentation. Which of the following represents the most appropriate best practice approach to address this identified risk? Option A. Authorize the most experienced compliance officer to manually review and correct any flagged discrepancies as they arise, relying on their judgment to ensure accuracy. Option B. Temporarily halt all new client onboarding until a complete overhaul of the identity validation system can be completed, even if this significantly impacts business operations. Option C. Instruct the compliance team to conduct a one-off review of all historical onboarding data to identify and correct any past errors, and then revert to the existing ad hoc remediation process for new discrepancies. Option D. Implement a standardized, multi-stage validation process for all identity documents, incorporating automated checks where feasible, and establish a clear, documented procedure for investigating and resolving any flagged discrepancies, including a review and approval workflow for all corrections. The correct answer is D. Implement a standardized, multi-stage validation process for all identity documents, incorporating automated checks where feasible, and establish a clear, documented procedure for investigating and resolving any flagged discrepancies, including a review and approval workflow for all corrections. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient data processing with the imperative to maintain data integrity and comply with regulatory expectations regarding data handling and reporting. The firm's internal risk assessment has identified a potential weakness, necessitating a proactive and robust response. The core of the challenge lies in ensuring that any remediation efforts do not inadvertently introduce new risks or compromise the accuracy of financial reporting, which is paramount under regulatory frameworks. The correct approach represents best professional practice because it prioritizes a systematic, documented, and validated process for addressing the identified data anomaly. This involves a thorough investigation to understand the root cause, followed by the development and implementation of a corrective action plan that is tested and verified before being fully deployed. This methodical approach ensures that the fix is effective, sustainable, and does not create further issues. It aligns with regulatory expectations for robust internal controls, data governance, and accurate financial reporting, demonstrating a commitment to compliance and risk management. An incorrect approach that involves immediately correcting the data without a proper investigation risks masking the underlying systemic issue, potentially leading to recurrence. This bypasses essential control procedures and could be viewed by regulators as a failure to implement adequate risk mitigation strategies. Another incorrect approach, such as relying solely on anecdotal evidence or the judgment of a single individual to rectify the problem, lacks the necessary documentation and validation. This can lead to inconsistent application of corrections, potential errors, and a lack of audit trail, which is a significant regulatory concern. Furthermore, an approach that delays remediation due to resource constraints without a clear plan for escalation or prioritization demonstrates a lack of diligence and could result in continued exposure to the identified risk, potentially leading to regulatory scrutiny and penalties. Professionals should approach such situations by first understanding the full scope and impact of the identified risk. This involves engaging relevant stakeholders, documenting the investigation process, and developing a clear remediation plan with defined responsibilities and timelines. The plan should include testing and validation phases to ensure the effectiveness of the proposed solution. Regular communication with senior management and relevant oversight bodies is crucial to maintain transparency and ensure adequate resources are allocated. The decision-making process should be guided by principles of prudence, compliance, and the protection of the firm's reputation and financial integrity. Question 13. Stakeholder feedback indicates that a key client, a sophisticated institutional investor, has requested a deviation from standard onboarding procedures for a new account, citing competitive pressures and the need for expedited execution. The proposed deviation involves a reduced level of due diligence on the source of funds for an initial, relatively small deposit. Option A. Delegate the decision to the relationship manager responsible for the client, trusting their judgment on the client's overall risk profile. Option B. Inform the client that the request cannot be accommodated and proceed with the standard onboarding procedures without further discussion. Option C. Immediately approve the deviation to maintain a positive client relationship and secure the business, assuming the initial deposit is small enough to pose minimal risk. Option D. Escalate the request to the compliance department for a thorough review of the proposed deviation against all relevant regulatory requirements and internal policies, seeking their expert guidance before making any decision. Correct answer is D. Escalate the request to the compliance department for a thorough review of the proposed deviation against all relevant regulatory requirements and internal policies, seeking their expert guidance before making any decision. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for client satisfaction with the long-term integrity of the firm's risk management framework and adherence to regulatory expectations. The challenge lies in discerning when client requests, even if seemingly minor or driven by competitive pressures, could inadvertently lead to breaches of regulatory requirements or compromise internal control processes. Careful judgment is required to assess the potential impact of such requests on market integrity, client protection, and the firm's reputation. The correct approach represents best professional practice because it prioritizes a thorough, documented assessment of the client's request against established regulatory guidelines and internal policies. This involves engaging relevant internal expertise, such as compliance and risk management, to ensure a comprehensive evaluation of potential risks and regulatory implications. This proactive and systematic approach demonstrates a commitment to upholding the principles of responsible business conduct, client due diligence, and regulatory compliance, which are fundamental to maintaining trust and a strong reputation in the financial services industry. It aligns with the overarching regulatory objective of ensuring market stability and protecting investors. An incorrect approach that involves immediately acceding to the client's request without proper due diligence would represent a significant regulatory and ethical failure. This could lead to breaches of anti-money laundering AML regulations, know your customer KIC requirements, or market abuse rules, depending on the nature of the request. Such a failure exposes the firm to substantial fines, reputational damage, and potential legal repercussions. Another incorrect approach, such as deferring the decision indefinitely without clear communication or a defined resolution path, demonstrates a lack of proactive risk management and can erode client confidence, potentially leading to a loss of business and damage to the firm's service reputation. This also fails to meet the regulatory expectation of timely and effective risk mitigation. Professionals should adopt a decision-making framework that begins with a clear understanding of the client's request and its context. This should be followed by an objective assessment against all applicable regulatory frameworks and internal policies. If the request appears to push boundaries or raise concerns, the next step is to consult with internal subject matter experts in compliance, legal, and risk. The decision should be documented, including the rationale for approval or rejection and any mitigating actions taken. Open and transparent communication with the client regarding the decision and its basis is crucial, even if the outcome is not what the client initially desired. This structured approach ensures that decisions are informed, defensible, and aligned with the firm's commitment to regulatory compliance and ethical conduct. Question 14. The efficiency study reveals that certain manual reconciliation processes within the trade settlement team are time-consuming and prone to human error. The head of operations proposes to automate these processes by implementing a new software solution, but suggests bypassing the standard IT security review and the full compliance sign-off to expedite deployment and realize cost savings sooner. Option A. Delay the implementation of the software solution indefinitely due to the potential risks identified, opting to continue with the existing manual processes. Option B. Implement the software solution with minimal IT involvement, focusing only on the functional aspects of automation and deferring compliance checks to a later, unspecified date. Option C. Implement the software solution after a thorough risk assessment, phased rollout, and comprehensive review by IT security and compliance teams to ensure all regulatory requirements and internal controls are met. Option D. Proceed with the immediate implementation of the software solution, as proposed by the head of operations, to achieve rapid cost savings, assuming the new software is inherently secure. Correct answer is C. Implement the software solution after a thorough risk assessment, phased rollout, and comprehensive review by IT security and compliance teams to ensure all regulatory requirements and internal controls are met. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the imperative to maintain robust internal controls and compliance with regulatory expectations. The pressure to demonstrate cost savings can inadvertently lead to the erosion of critical checks and balances, increasing the risk of operational errors, fraud, or non-compliance. Careful judgment is required to identify solutions that enhance efficiency without compromising the integrity of financial reporting or client service. The correct approach represents best professional practice because it prioritizes a thorough risk assessment and a phased implementation of changes. This aligns with regulatory expectations for sound risk management frameworks, which are fundamental to maintaining financial stability and protecting clients. By involving relevant stakeholders, including compliance and risk management teams, and conducting pilot testing, the firm demonstrates a commitment to due diligence and a proactive approach to identifying and mitigating potential issues before widespread adoption. This methodical process ensures that efficiency gains do not come at the expense of regulatory adherence or operational resilience, thereby upholding the firm's reputation and its obligations under relevant financial regulations. An incorrect approach that focuses solely on immediate cost reduction without adequate risk assessment would be professionally unacceptable. This would represent a failure to adhere to the principles of sound governance and risk management, potentially violating regulatory requirements that mandate robust internal controls. Such an approach could lead to increased operational errors, misstatements in financial reporting, or even breaches of client confidentiality, all of which carry significant regulatory penalties and reputational damage. Another incorrect approach that bypasses established change management protocols and stakeholder consultation would also be professionally unsound. This demonstrates a disregard for the importance of cross-functional collaboration and the expertise of compliance and risk departments. It increases the likelihood of overlooking critical control points or failing to anticipate unintended consequences, thereby exposing the firm to regulatory scrutiny and potential sanctions. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objectives of the efficiency initiative. Second, conduct a comprehensive risk assessment, identifying potential operational, financial, and regulatory risks associated with proposed changes. Third, consult with all relevant departments, including compliance, risk management, legal, and IT, to gather input and ensure alignment. Fourth, develop a detailed implementation plan that includes pilot testing, training, and ongoing monitoring. Finally, establish clear metrics for evaluating the success of the initiative, ensuring that efficiency gains are achieved without compromising control effectiveness or regulatory compliance. Question 15. The monitoring system demonstrates that a prospective corporate client operates a novel business model involving decentralized finance, DeFi, protocols, and the tokenization of illiquid assets. While initial checks reveal no direct links to illicit activities, the complexity and emerging nature of the business model present a higher-than-average risk profile for potential money laundering or terrorist financing. What is the most appropriate next step for the firm? Option A. Escalate the client for enhanced due diligence by a specialized team to thoroughly assess the risks associated with their unique business model. Option B. Place the client's application on indefinite hold pending further clarification without a defined process for resolution. Option C. Approve the client for standard onboarding procedures, assuming the absence of direct negative information implies low risk. Option D. Immediately reject the client's application due to the inherent risks associated with novel and complex business models in the financial sector. The correct answer is A. Escalate the client for enhanced due diligence, ED, by a specialized team to thoroughly assess the risks associated with their unique business model. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient client onboarding with the stringent regulatory obligations to prevent financial crime. The firm must ensure that its Know Your Customer kick and anti-money laundering AML procedures are robust enough to identify and mitigate risks, while also avoiding unnecessary delays that could harm client relationships and business operations. The core tension lies in the potential for a new client's business model to be legitimate but complex, requiring deeper scrutiny than a standard onboarding process. The correct approach represents best professional practice because it prioritizes regulatory compliance and risk mitigation without being overly restrictive. By escalating the client for enhanced due diligence, ED, when the initial screening flags potential complexities, the firm demonstrates adherence to the principle of proportionality in its risk-based approach. This aligns with the Financial Conduct Authority (FCA) handbook, specifically SISC systems and controls, and AML handbooks, which mandate that firms establish and maintain adequate systems and controls to prevent financial crime. Escalation ensures that a more experienced team, equipped with the necessary expertise, can thoroughly assess the risks associated with the client's novel business model, thereby fulfilling the firm's regulatory duty to understand its customers and the nature of their business. This proactive stance prevents potential breaches of AML regulations and reputational damage. An incorrect approach that involves immediately rejecting the client without further investigation would be professionally unacceptable. This fails to acknowledge that novel business models are not inherently illicit and could lead to the rejection of legitimate business, potentially violating principles of fair dealing and market access. It also demonstrates a lack of understanding of the risk-based approach, which requires proportionate measures rather than blanket prohibitions. Another incorrect approach, approving the client without any further scrutiny despite the flagged complexities, represents a severe regulatory and ethical failure. This directly contravenes the firm's obligations under the Money Laundering Regulations 2017 and the FCA's AML guidance. It exposes the firm to significant risks of facilitating money laundering or terrorist financing, leading to substantial fines, reputational damage, and potential criminal prosecution. This approach shows a disregard for due diligence and a failure to implement adequate systems and controls. A third incorrect approach, delaying onboarding indefinitely while awaiting further information without a clear plan or timeline, is also professionally problematic. While caution is necessary, indefinite delays without a structured process can be seen as a failure to conduct business efficiently and can also lead to regulatory scrutiny for not having effective onboarding processes. It suggests a lack of proactive risk management and can be detrimental to client relationships. A professional decision-making process in such situations should involve a clear understanding of the firm's risk appetite and regulatory obligations. When a monitoring system flags potential complexities, the immediate step should be to assess the nature of the flag against established risk criteria. If the complexity suggests a higher risk profile, the process should automatically trigger a review by a designated team responsible for enhanced due diligence. This team should have clear protocols for gathering additional information, assessing the legitimacy of the business model, and making a risk-based decision. Communication with the client should be transparent regarding the need for additional information and the expected timeline, demonstrating a commitment to both compliance and client service. Question 16. The performance metrics show a significant deviation from the client's previously experienced strong returns, leading to client anxiety about their portfolio's current trajectory. The client is expressing a desire to revert to strategies that mirrored past successes, even if they carry higher risk. Option A. Downplay the recent performance dip and focus on generic reassurances about the long-term nature of investing, without delving into specific reasons for the current performance or potential risks. Option B. Suggest a temporary pause in all investment activity until market conditions stabilize, to avoid further potential losses and alleviate client concerns. Option C. Immediately propose a shift to a more aggressive investment strategy that has historically delivered high returns, to reassure the client and attempt to replicate past performance. Option D. Engage in a detailed discussion with the client to explain the current market environment, the inherent volatility of investments, and the importance of aligning investment strategy with their long-term objectives and current risk tolerance, rather than chasing past performance. The correct answer is D. Engage in a detailed discussion with the client to explain the current market environment, the inherent volatility of investments, and the importance of aligning investment strategy with their long-term objectives and current risk tolerance, rather than chasing past performance. Explanation. This scenario presents a common challenge in financial advisory where client expectations, driven by past performance, clash with current market realities and regulatory obligations. The professional is tasked with managing these expectations responsibly while adhering to the principles of suitability and client best interests, as mandated by UK financial regulations and SISI guidelines. The correct approach demonstrates best professional practice by prioritizing a transparent, client-centric communication strategy. It involves clearly explaining the reasons for the performance shift, the inherent risks of investments, and recalibrating expectations based on current market conditions and the client's evolving risk profile and objectives. This aligns with the regulatory duty to act in the client's best interests, provide clear and fair information, and ensure that advice is suitable. It also reflects the ethical imperative of honesty and integrity in client relationships. An incorrect approach that focuses solely on reassuring the client without addressing the underlying performance issues or risks fails to meet the suitability requirements. It risks misleading the client about the true nature of their investments and could lead to further dissatisfaction or inappropriate investment decisions. This could be seen as a breach of the duty to provide suitable advice and to act with due skill, care, and diligence. Another incorrect approach that involves suggesting a drastic change in investment strategy solely to chase past performance, without a thorough reassessment of the client's objectives and risk tolerance, would be a significant regulatory and ethical failure. This would likely contravene the principle of suitability, as the proposed changes may not be in the client's best interests and could expose them to undue risk. It also demonstrates a lack of professional judgment and a failure to uphold the integrity of the advisory process. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly analyze the performance data and identify the root causes of the shift. Second, conduct a comprehensive review of the client's current financial situation, objectives, and risk tolerance. Third, develop a clear, evidence-based communication plan that addresses the client's concerns, explains the market context, and outlines a revised, suitable strategy. Finally, document all discussions and decisions meticulously to ensure compliance and provide a clear audit trail. Question 17. Benchmark analysis indicates that junior analysts often face situations where client transaction patterns are concerning but not definitively indicative of illegal activity. In such a scenario, what is the most appropriate course of action for a junior analyst at a UK-regulated financial institution to take, adhering strictly to the Proceeds of Crime Act 2002 and FCA guidelines? Option A. Directly approach the client to seek clarification on the suspicious transaction patterns. Option B. Immediately escalate the findings to the firm's compliance department or money laundering reporting officer, MLRO, for further investigation and assessment. Option C. Conduct further independent research to gather more definitive evidence of illegal activity before reporting anything. Option D. Formulate a personal opinion on the legality of the transactions and take no further action if the opinion is that no crime has occurred. Correct answer is B. Immediately escalate the findings to the firm's compliance department or money laundering reporting officer, MLRO, for further investigation and assessment. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. A junior analyst, tasked with reviewing client transactions, uncovers patterns that, while not definitively illegal, raise significant concerns about potential money laundering. The challenge lies in balancing the duty of loyalty to the client with the paramount responsibility to uphold financial integrity and comply with anti-money laundering (AML) regulations. Misjudging this balance can lead to severe regulatory penalties, reputational damage for the firm, and ethical breaches. The correct approach involves escalating the findings through the firm's established internal reporting channels, specifically to the Compliance Department or the Designated Money Laundering Reporting Officer, MLRO. This aligns with best professional practice and regulatory requirements, such as those outlined in the UK's Proceeds of Crime Act 2002, POCA, and the Financial Conduct Authority's, FCA, Conduct of Business Sourcebook, COBS. These regulations mandate that financial institutions have robust systems and controls in place to prevent financial crime. By reporting internally, the analyst ensures that the matter is investigated by individuals with the expertise and authority to assess the risk, determine if a suspicious activity report, SAR, needs to be filed with the National Crime Agency, NCA, and manage the client relationship appropriately. This process protects the firm from regulatory sanction and upholds the integrity of the financial system. An incorrect approach would be to ignore the suspicious activity due to a lack of definitive proof of illegality. This failure to escalate would violate the firm's internal AML policies and potentially POCA, which requires reporting where there is knowledge or suspicion of money laundering. Another incorrect approach is to directly contact the client to inquire about the transactions. This action would breach client confidentiality and could tip off the client, hindering any potential investigation and constituting a criminal offense under POCA. Furthermore, attempting to make a judgment call on the legality of the transactions without consulting compliance is a significant ethical and regulatory failure, as it bypasses the established risk assessment framework and places undue responsibility on an individual not equipped for such a decision. The professional decision-making process in such situations should involve a clear understanding of the firm's internal policies and procedures for reporting suspicious activity. When faced with ambiguous but concerning transactions, the default professional action is to escalate. This involves documenting the observations clearly and concisely and reporting them to the appropriate internal authority, such as the MLRO or Compliance Department. This ensures that the firm can fulfill its regulatory obligations proactively and responsibly, safeguarding both its reputation and the broader financial ecosystem. Question 18. System analysis indicates that a new client onboarding system is being developed to streamline the process and improve efficiency. This system will collect and process a significant volume of sensitive client personal data. What is the most appropriate approach to ensure compliance with data protection regulations and protect client privacy throughout the implementation and operation of this new system? Option A. Rely on the IT department's standard security measures, assuming they are sufficient for handling all types of client data. Option B. Conduct a comprehensive data protection impact assessment (DPIA) before the system is deployed to identify and mitigate potential privacy risks. Option C. Initiate a formal data protection impact assessment (DPIA) only after a data breach has occurred to understand the root cause and prevent recurrence. Option D. Implement the system with existing IT security protocols and conduct informal data privacy reviews as needed during the initial operational phase. The correct answer is B. Conduct a comprehensive data protection impact assessment (DPIA) before the system is deployed to identify and mitigate potential privacy risks. Explanation. Scenario analysis. This scenario presents a common challenge in financial services, balancing the need for efficient data processing with the imperative to comply with stringent data protection regulations. The core difficulty lies in identifying and mitigating risks associated with handling sensitive client information when implementing a new system. A failure to adequately address these risks can lead to significant regulatory penalties, reputational damage, and loss of client trust. The pressure to deliver a functional system quickly can sometimes overshadow the meticulous planning required for robust data security and privacy. Correct approach analysis. The correct approach involves a proactive and comprehensive data privacy impact assessment, DPIA, conducted before the system goes live. This aligns with the principles of data protection by design and by default, as mandated by regulations like the UK GDPR. A DPIA systematically identifies potential risks to individuals' rights and freedoms arising from the processing of personal data. It requires a thorough understanding of the data flows, the types of data being processed, the purposes of processing, and the technical and organizational measures in place to protect that data. By conducting this assessment upfront, the firm can identify and implement necessary safeguards such as anonymization, pseudonymization, access controls, and encryption to mitigate identified risks. This demonstrates a commitment to regulatory compliance and ethical data handling, ensuring that client privacy is a foundational element of the new system, not an afterthought. Incorrect approach is analysis. Implementing the system without a formal DPIA and instead relying on ad hoc reviews during or after deployment represents a significant regulatory and ethical failure. This approach violates the principle of data protection by design, as it fails to embed privacy considerations from the outset. It increases the likelihood of overlooking critical risks, potentially leading to breaches of data protection laws. Relying solely on the IT department's existing security protocols is insufficient, as it may not encompass the specific privacy implications of the new system's functionality and data handling practices. This could result in noncompliance with requirements for data minimization, purpose limitation, and individual rights. Conducting a DPIA only after a data breach has occurred is a reactive and unacceptable approach. It signifies a failure to prevent harm and demonstrates a disregard for regulatory obligations to proactively protect personal data. Such a delay would likely incur severe penalties and damage the firm's reputation. Professional reasoning. Professionals should adopt a risk-based approach, prioritizing proactive compliance. The decision-making process should involve 1. Understanding the regulatory landscape relevant to data processing, e.g., UK GDPR. 2. Identifying all personal data involved in the new system and its intended use. 3. Conducting a thorough DPIA to assess potential privacy risks. 4. Implementing appropriate technical and organizational measures to mitigate identified risks. 5. Documenting the DPIA process and the implemented safeguards. 6. Establishing ongoing monitoring and review mechanisms to ensure continued compliance. This systematic approach ensures that data protection is integrated into the project lifecycle, fostering trust and minimizing legal and reputational exposure. Question 19. The evaluation methodology shows that the implementation of a new regulatory reporting system is behind schedule, with the go-live date looming. The project team is considering bypassing user acceptance testing, UAT, with a subset of end users and proceeding directly to full deployment, relying on the vendor's internal testing and a limited pilot with a few internal staff. Option A. Delay the go-live indefinitely until all potential issues are resolved through extensive internal testing, even if it means missing the regulatory deadline. Option B. Implement the system immediately with minimal internal testing, assuming the vendor's solution is robust and any minor issues can be rectified post-launch through patches. Option C. Expedite the go-live by skipping user acceptance testing and relying solely on the vendor's internal testing, with a brief internal pilot to confirm basic functionality. Option D. Proceed with a phased rollout, prioritizing comprehensive user acceptance testing with a diverse group of end users, and conducting parallel runs with the existing system for a defined period before full deployment. Correct answer is D. Proceed with a phased rollout, prioritizing comprehensive user acceptance testing with a diverse group of end users, and conducting parallel runs with the existing system for a defined period before full deployment. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient implementation of a new regulatory reporting system with the imperative to ensure data integrity and compliance. The pressure to meet deadlines can lead to shortcuts that compromise accuracy, potentially resulting in regulatory breaches and reputational damage. Careful judgment is required to identify and mitigate these risks without unduly delaying the project. The correct approach represents best professional practice because it prioritizes a phased rollout with robust testing and validation at each stage. This aligns with regulatory expectations for accurate and timely reporting, as mandated by frameworks like the FCA's Financial Conduct Authority, Principles for Business, specifically Principle 3, Management and Control, and Principle 7, Communications with Clients, which implicitly require reliable systems for client reporting and regulatory submissions. By conducting user acceptance testing, UAT, with a representative sample of end users and performing parallel runs with the old system, the team ensures that the new system functions as intended and produces accurate data before full deployment. This proactive approach minimizes the risk of errors and ensures compliance with reporting obligations. An incorrect approach that focuses solely on meeting the go-live date without adequate validation would fail to uphold regulatory standards. For instance, Skipping UAT or parallel runs could lead to the submission of inaccurate or incomplete regulatory reports, violating the integrity of financial data. This would be a direct breach of the FCA's expectations for accurate record-keeping and reporting, potentially leading to fines and sanctions. Another incorrect approach, such as relying entirely on vendor assurances without internal verification, demonstrates a lack of due diligence and an abdication of responsibility for ensuring compliance. This overlooks the firm's ultimate accountability for the accuracy of its regulatory submissions, regardless of third-party involvement. The professional decision-making process for similar situations should involve a risk-based assessment. This means identifying potential failure points in the implementation process, evaluating their likelihood and impact, and developing mitigation strategies. Prioritizing tasks that directly impact data accuracy and regulatory compliance is crucial. Professionals should advocate for sufficient time and resources for testing and validation, even if it means adjusting timelines. Open communication with stakeholders about risks and proposed solutions is also essential for managing expectations and securing necessary support. Question 20. Quality control measures reveal that a significant volume of client data, including sensitive personal information, was inadvertently exposed to an unauthorized third party due to a misconfiguration in a cloud-based data storage system. The exposure occurred over a period of several weeks before detection. What is the most appropriate immediate course of action for the firm? Option A. Attempt to rectify the system misconfiguration and monitor for any signs of data misuse, deferring client and regulatory notification until definitive evidence of actual data compromise is established. Option B. Inform senior management of the potential issue and await their directive on how to proceed, focusing initially on securing the data without immediate external communication. Option C. Immediately initiate a comprehensive internal investigation to determine the full scope of the exposure. Engage with legal and compliance teams to assess regulatory notification requirements, and prepare to notify affected clients and relevant authorities as mandated by law. Option D. Proceed with notifying only a select group of high-profile clients who are most likely to be impacted, while continuing to investigate the extent of the exposure for other clients. The correct answer is C. Immediately initiate a comprehensive internal investigation to determine the full scope of the exposure. Engage with legal and compliance teams to assess regulatory notification requirements, and prepare to notify affected clients and relevant authorities as mandated by law. Explanation. This scenario presents a professional challenge due to the inherent tension between the need for efficient data processing and the stringent regulatory requirements for data integrity and client confidentiality. The challenge lies in identifying and rectifying a systemic issue that could have far-reaching implications for client trust, regulatory compliance, and the firm's reputation. Careful judgment is required to balance the urgency of the situation with the need for a thorough, compliant, and ethical resolution. The correct approach represents best professional practice because it prioritizes immediate, transparent, and comprehensive action in line with regulatory expectations for data breach notification and remediation. This involves a multifaceted strategy that includes immediate containment, thorough investigation, client notification, and proactive engagement with regulatory bodies. This aligns with principles of good governance, client duty of care, and adherence to data protection regulations, ensuring that the firm acts responsibly and ethically when faced with a potential data compromise. An incorrect approach that involves downplaying the issue or delaying notification would represent a significant regulatory and ethical failure. Specifically, it could violate data protection laws by failing to report a breach within the mandated timeframe, leading to substantial fines and sanctions. Ethically, it breaches the duty of care owed to clients by withholding critical information that could impact their security and privacy. Another incorrect approach, such as attempting to fix the issue without proper documentation or regulatory consultation, risks incomplete remediation and a lack of transparency, further compounding the initial failure and potentially leading to ongoing noncompliance. The professional decision-making process for similar situations should involve a structured risk assessment, immediate escalation to relevant internal stakeholders, e.g., compliance, legal, IT security, and a clear understanding of the firm's regulatory obligations. Professionals must prioritize transparency, accuracy, and timeliness in all communication, both internal and external. This involves a commitment to thorough investigation, robust remediation, and proactive engagement with regulatory authorities to demonstrate a commitment to compliance and client protection.